Here's our study guide for today. We'll start with the incomplete records mystery, move on to the 3 single entry systems, dive into the profit calculation formula, look at business expenses versus drawings, and finish up with a real-world capital example. Imagine walking into a room, a literal crime scene, where half the clues have just been swept away. That is exactly what it feels like when dealing with incomplete financial records. So the big question we're trying to solve today is, how do you calculate a business's profit when standard double-entry books just don't exist? Honestly, it's the ultimate puzzle of single-entry bookkeeping. It's a total mystery just waiting to be solved.
Section 1. The incomplete records mystery. Why do records go missing? Okay, before we solve the case, we have to understand the environment we're actually working in. The single-entry system is formally defined as an inaccurate, unscientific, and unsystematic method of recording business transactions. What's wild here is that the duality principle, that absolute golden rule of accounting where every debit has an equal and opposite credit, is completely ignored, gone. This system generally only keeps track of cash transactions and personal accounts. That means complete real and nominal accounts are totally absent from the picture. So why do we even encounter this financial crime scene in the real world? Why not just use double entry and save everyone a headache? Well, very often, it's a simple lack of formal accounting knowledge. Think about a street vendor selling vegetables. Are they really going to sit down and maintain complex ledgers? Definitely not. Other times, a sole proprietorship is just too small to justify the time and effort. And sometimes it's a literal disaster. Records can be destroyed by a freak accident, like a fire in the shop. When that happens, essential figures become totally unknown, meaning they have to be calculated as balancing figures or just really carefully estimated.
Section 2. 3 single entry systems, the levels of incomplete bookkeeping.
Our first level is pure single entry. Now, in this system, only personal accounts are maintained. That means absolutely zero information is available for cash, bank balances, sales, or purchases. As financial detectives, this gives us, quite literally, almost nothing to work with. Because it fails to provide even basic information regarding cash, this method basically only exists on paper. It has virtually no practical application in the real world.
The second type is simple single entry. Here, personal accounts are kept, but we also get a cash book. Now, having a cash book is definitely a step up, but it comes with a massive trap for our detective work. In this system, business and personal transactions are frequently just all mixed up together in that same cash book. Imagine trying to untangle a store owner's personal grocery money from the shop's actual daily earnings. It makes calculating the true business profit an absolute headache.
Finally, we have the quasi-single entry system. This one brilliantly illustrates how a business kind of tries to bridge the gap toward proper accounting. It maintains personal accounts, a cash book, and adds in some subsidiary books like sales, purchases, and bills books. While there's no separate record maintained for discounts, it does give us some scattered information on expenses like wages and rent. In fact, this is the method generally adopted as a substitute for the double entry system. It finally gives us a few more vital clues to work with.
Section 3. The profit calculation formula, the capital comparison method. Since we don't have proper revenue and expense accounts to find the profit, we've got to be a little clever here. We find profit by tracking the changes in the owner's capital from the very start of the year right to the end of the year. Let's walk through these logical building blocks. Step 1, find the closing capital. Step 2, add any owner drawings back in. Now you might be wondering, why do that? Because that was value the business organically generated before the owner just pulled it out for personal use. Step 3, deduct any fresh capital introduced during the year, simply because that's outside money injected into the business, not operational profit. And finally, step 4, deduct the opening capital. What you're left with after all these adjustments is the true, organically generated profit or loss. Pretty neat, right?
Section 4. Business expenses versus drawings. Are these clues or just red herrings?
This distinction right here is the absolute biggest pitfall in calculating capital. You really have to scan the business transactions incredibly carefully. On one hand, we have legitimate business expenses. Rent for the shop premises, employee salaries, electricity for the store. Standard stuff. But on the other, drawings. These include things like the owner's residential rent, life insurance premiums of the proprietor paid straight from business cash, household expenses, and even personal gifts to friends taken right out of the till. None of these are business expenses. They are literally withdrawals of the owner's capital. And that brings us to a major warning for anyone analyzing these records. If you misclassify a personal drawing as a business expense, your final calculated profit is going to be entirely skewed. Your assessment of the business's overall health will be fundamentally wrong, mostly because you've effectively hidden the owner taking money out of the company by pretending it was just a regular cost of doing business. Identifying these clues correctly, it's absolutely non-negotiable.
Section 5. Real-world capital example. Let's solve the case.
All right, so to use our formula, we first need the opening and closing capital. We find this by preparing what's called a Statement of Affairs. Think of it as a makeshift balance sheet specifically for incomplete records. We gather up all the known assets, buildings, inventory, cash, which gives us an opening balance of $381,200. Then we subtract our liabilities like creditors and loans, which are $140,000. That leaves us with a derived opening capital of $241,200. Doing the exact same process at the end of the year, our derived closing capital is $440,700. Boom! We've got our baseline clues.
Now, let's assemble all our missing clues and plug them directly into that 4-step formula we talked about. We start with that closing capital of $440,700. Through our detective work, we found out the proprietor withdrew $2,000 a month for personal use. So we add those drawings back, which is $24,000 for the entire year. We then deduct the $40,000 of fresh capital they introduced halfway through the year. And finally, we deduct our starting point, that opening capital of $241,200.
We do the arithmetic and there it is. The final calculated profit for the year is $183,500, just by comparing the capitals at 2 different points in time and carefully adjusting for drawings and fresh investments. We literally took a chaotic, completely incomplete set of records and actually found the financial truth. Honestly, it gives you such an incredible sense of resolution to crack a financial case like this.
But hey, before we officially close this case file, I want to leave you with one final thought. Yes, your profit is calculated, but without true double-entry books, can you ever 100% trust the result? Think about it. Under a single-entry system, profit is ultimately just an estimate based on whatever information happened to be available. If an asset or a liability was just completely omitted from our makeshift statement of affairs, there is no trial balance to warn us that something's wrong. Our final number would just quietly be completely incorrect. Kind of scary, right? It really makes you appreciate the absolute necessity of systematic double-entry accounting. Thanks so much for joining me on this explainer, and keep those financial detective skills sharp.